All right. Today is Sunday, October 8th, and this is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. And let's just say that I wrote a bunch of jokes for you to open the show tonight, but given the situations, we're going to pass on that. A lot of sensitive people here. You know, they get offended by jokes. How are they going to handle the challenges of life? That's a different story, but we begin where we left the conversation last Thursday. The stock market was stuck in purgatory. It ran way too high year to date, but recently the stock market has been under a correction, the first one this year. We had a scare episode during the SVB collapse earlier this year, but at least for now, it appears to be a benign event that the market was able to pass. Of course, we're going to look back at the SVB collapse as the warning signal for what's about to happen, but one step at a time, folks. Since the market began correcting, a lot of individual stocks dropped down big. They became really oversold. And the index itself, the S&P 500, also became a little oversold. And it consolidated for a little while in what we called the purgatory. And why is that? Usually after a major correction, the conversation begins. Is this really the dip that we've been waiting for? And higher we go again? Or did something change in the narrative that led the market higher? Now, I agree with the latter, that the narrative has changed, although I differ to say that the narrative has been the same since last year. Inflation went way too high, the Fed has been raising rates to tackle inflation down, and the economy is going to buckle at some point. To defeat inflation, we need to create a recession. And I believe that the narrative has not been changed, but the market now is finally listening somehow. Not entirely, but at least in certain sectors. The stock market is listening. But in the meantime, the stock market also follows the technicals. And the technicals are really important in times when we have market participants all divided. After the first serious correction that we got this year so far, the market is divided. You have one camp that says, yep, we told you all along that this is going to go down, that you can't really stretch it for too long. Inflation is way too high. To tackle inflation, interest rates will have to go way too high. Something is going to break in the system, and stock market valuations will not be able to hold up. Not to mention, of course, that higher rates will impact the economy negatively. And then you have the other camp that perhaps still sitting on profits year to date. They bought the AI mania narrative and they bought certain stocks. And despite the corrections that we've seen so far, the so-called Magnificent Seven haven't been really impacted to a serious degree so far. At least not yet. Keyword, yet. Until one of the two teams capitulates, either the bears say, okay, this is going to be higher we go from here, it was just a correction, and the AI narrative will take us out of a recession. And they capitulate and they start to buy. And then the stock market recovers and goes back to the highs. Or the holders will somehow capitulate and say, okay, the market is not moving higher anymore. It is failing to rebound. It is failing to rally. And oh, by the way, the narrative from the bears, but bond yields moving way too high, which will force the economy to buckle, along with the stock market. Perhaps there is some reality to that. And instead of being greedy pigs, we're going to book our profits right now in these Magnificent Seven names, and then we see the stock market flushing down, and we get a final resolution to what happened this year. It was all false, and at the end of the day, it buckled under the pressure and the gravity of higher rates. And I believe that this will be the case. But in the meantime, until somebody capitulates, the purgatory we've been talking about is technical in nature. It is the S&P 500 being stuck between the 200 days moving average and the 150 days. And if we have a break above, we would likely see an oversold bounce/rebound that could last for days, if not weeks. But we see some sort of a recovery here, despite the fact that it's not going to be long lasting, and sooner than later, we're going to go down. On the other hand, if the S&P breaks the 200 days moving average right away, then we have the answer that a lot of the holders are now capitulating, and the stock market will enter a crash scenario. Well, what did we get on Friday? The answer is, here's the chart for you. The closing on Friday, we closed above the 150 days moving average, not below the 200 days moving average. So we know that right now, the technicals, the charts are saying we are now favoring an oversold bounce/rebound scenario, that we could see some sort of relief here in the stock market, as maybe we see the dollar index cooling off, maybe running out of gas for a little while, and maybe we see bond yields also cooling off for a little bit. And this will allow the stock market to recover, but ultimately it would be a trap because we're going to go down again absent of resolving the bond market dilemma. Now, the oversold rebound, if we plug in the Bollinger Bands and the 20 days moving average in white, we can see that there is a potential for the rebound rally to go all the way to at least the 20 days moving average, if not even surpass that, and aim for the 50. But we have to back up here. Why will any rebound from here fail? The answer is it all comes back to the bond market here. And unless we're able to resolve the dilemma in the bond market, there is no bottom in equities here, and we're going to go down. What dilemma are we talking about here, Maverick? We're talking about the fact that interest rates are surging significantly higher, despite the fact that the Federal Reserve is not really raising rates anymore. So what's up with that? We have a multitude of reasons here. The headline from the Journal says that Wall Street is not sure it can handle all of Washington bonds. So we know that one of the major reasons behind the rise in interest rates, despite the fact that the Fed is not raising rates effectively, is the fact that we have foreign nations such as China and Japan and Germany and Saudi all dumping U.S. bonds because now their domestic markets, their own bonds, pay a positive, if not higher yields. If you happen to be a retirement or a pension fund in Germany or Japan, you've been buying U.S. bonds for years, and now you see that your domestic bonds are paying a higher yield. Yields are rising, why not stick with your own domestic market and diversify out of U.S. bonds? But on top of that, we have perhaps a bigger reason why we're seeing bond yields surging higher here. And it is the massive amount of issuance here, the deluge of bond issuance that is flooding the market. So when you increase the supply of bonds, the prices go down. When the price of bonds go down, yields go higher on these bonds. And the only way to stop them right now is to find a buyer. Well, who's going to be the buyer? Now, you and me have been buying these bonds because we like the yields. So we parked some money in money market funds. We parked some cash in T-bills. But we're just small potatoes, you and me. We need major players with billions, if not trillions of dollars, buying bonds at these prices right now. How is that going to happen? 2 scenarios, not a third, only 2. So if you see bond yields going down, absent of these 2 reasons, it's a pullback, it's going to be transitory, and bond yields are going to go higher again. And this is why the market will struggle at any attempt for a rebound. And the reason is bond yields will rebound. The 2 scenarios are, number 1, either we face a systemic risk event, such as the collapse of a major bank globally. It doesn't have to be a US-based bank. But we've seen back during the episode of the SVB collapse and the collapse of First Republic Bank that bond yields went down dramatically. So that could be scenario number 1. What's going to resolve the dilemma in the bond market? But think about the magnitude that it would take to divert billions, if not trillions of dollars back into the bond market. It has to be a major financial crisis, a major bank collapsing. And the question now becomes, is that really good for the economy? Is that really good for the equities market? Of course not. In other words, if bond yields go down, they're going to go down for the wrong reasons, and they will take down the economy and the stock market with them. The other scenario, and again, the end effect is the same thing. Hundreds of billions of dollars, if not trillions of dollars, flooding into the bond market, buying these bonds, propping up the prices and dropping yields down. But this scenario requires manufacturing a sell-off in equities. Billions, if not trillions of dollars, come out of equities and rotate into the bond market. And then we see yields dropping for good. So either we face a systemic risk event organically, a credit event if you may, or we have to see a massive stock market sell-off to the tune of 20-30%, a crash to put an end to the rise in bond yields. And that, of course, revives the conversation about 1987. Hold that thought. We'll talk about it in a second, but on Friday, supposedly, we got a hot payroll report, so the economy is creating jobs like hotcakes, allegedly, of course. And Mohammed Al-Arian says that the hot jobs report, good news for the economy, bad news for the stock market. Something is likely to break. And the reason is bond yields went higher in response to that report. Now, I think that bond yields will cool down in the next few days based on the technicals alone. But the technicals alone will be only a transitory factor in pushing bond yields down. They're going to recover sooner or later without, number 1, a systemic risk event or a market crash. And the market, ladies and gentlemen, despite the propaganda of, oh, it's a bull market, it is actually based on really shaky ground here. The headline from Bloomberg says, Wall Street is worried about the bear market has unfinished business. Oh, we're talking about the bear market again. Uh-oh. I thought we're already in a bull market and all-time highs and the sky's the limit and there was no recession and inflation is gone. What happened here? Listen to this. more than 180 stocks in the benchmark, that is the S&P 500. So 180 stocks within the 500 stocks in the S&P are now trading for less than they were 12 months ago, even after the equity market snapped a 4-week losing streak with a rally Friday that drove it into a small gain. And a little over 2 months, more than a third of the S&P 500's advance this year has been erased, sapping investors' confidence and sowing fear that equities have further to fall. If the selling revives and the S&P 500 falls below 4,200, and we're getting really close now, but we escaped on Friday, so that is the exiting purgatory part. There are a few breakout levels where buyers could safely swoop in, according to technical analysts who monitor daily averages and other metrics as the gauge of stock market momentum. It closed Friday at 4,309. Listen to this. At the same time, the payouts, so this is really important for you to understand, how the money, either it's going to move to the bond market via a systemic risk event or organically and cause a stock market crash, and this will be the reason. At the same time, the payouts on short-term treasuries and other low-risk investments have pushed over 5%, giving investors another incentive to pull back from equities. Nearly $71 billion were poured into cash-like instruments during the week ended Wednesday, the biggest inflow since July, according to Bank of America. And of course, a lot of the pumpers and the business news media, when they talk about a bull market, they say, oh, look at the indices. We're back at almost to the highs here. Everything's okay. But you open the hood and you see that the health of this market, the so-called bull market, is actually bullshit. Around 1/3 of the Russell 2000 companies are not profitable. And this is the highest level in data going back to 1985. When we look at the S&P 500, sure, it's up 11% for the year, but the vast majority of these gains are coming from 7 stocks. The other 493 stocks are actually negative for the year. So absent of the 7 stocks, the S&P 500 should have been negative for the year. So now you know that this market is really on fragile ground right now. And when we talk about the bond market going higher and the inevitable scenario for market crash, because for bond yields to top, either number one, we will see a credit event, which will cause an exodus from stocks and a huge wave of buying of bonds, or we have to see an actual stock market crash without a credit event. The end result is the same. It's a stock market crash. So now we go back to 1987. You can see right here in black the 10-year yield 2023. Then in blue, you can see the 10-year yield 1987. We know in the examples of the GFC 2008-2009, what stopped bond yields is the systemic risk scenario. We saw the real estate market collapsing and then bond yields cooled off and they finally collapsed along with the crash of Lehman Brothers. In 1987, we did not see a systemic risk event, but what stopped the rise in bond yields is the following: the crash of 1987. So here in black, you see the NASDAQ in the year 2023, then you see in blue the Dow Jones in the year 1987. Again, identical moves, but then the stock market in 87 crashed big in what is now known as Black Monday. Question now becomes, are we on the cusp of yet another Black Monday-like event? And my answer is absolutely yes. But again, timing it is a really difficult endeavor. So if you say that it's going to happen this week, you're also facing the oversold technicals. And this is why all month long, I've been telling my followers that my trading strategy is holding long-term puts with the expiration date of November, December 24, and then hold short-term calls with the monthly expiration date of October. That way, if we have an oversold rebound, you get exposure that way. And if the market crashes later on, you also have your exposure to the downside by the puts. And so far, so good with this strategy. But folks, we now have to talk about what's happening in the Middle East and whether it has impact in the stock market or not. Obviously, if you're looking at the futures right now, you will see that stock market futures are down a little bit. You see that the dollar is up a little bit. You see that gold and silver are also up a little bit. So there is a little bit of rush to security here. But again, folks, the stock market is, for the most part, traded via algos and computerized programs. What they look at is not Israel-Palestine or Russia-Ukraine. These events, of course, in the long term, if they impact economics, if they impact commodities, they become important to the stock market. But in the meantime, what's more important to the stock market is the fact that we have the bond market closed on Monday for the holiday. And without the volatility of the bond market, wouldn't that be a relief for the stock market to at least continue to rebound? Furthermore, it appears that the dollar, despite the pop that you see in the pre-market, has already run out of gas in this move and it needs a pullback for a few days, maybe a week or so. Wouldn't that be a relief for the stock market that has been worried about the dollar rising higher? So sure, overnight we see that the Israeli market is down big, and frankly I don't understand why They kept the stock market open. They should have closed the stock market, and it's down at least, last time I checked, about 6.5%. And of course, regionally, for example, the Egyptian stock market is down about 2.6%. Now, if there is a resolution to the crisis, then we will see opportunities here in picking some of these ETFs, whether it be the Israeli ETF or the Egyptian ETF. But right now, the regional stock market is amidst the crisis, be it the Israeli stock market, be it the Egyptian stock market, and they will suffer. But that doesn't mean that the US stock market will care about what's going on in Israel right now, unless, of course, it spirals out of control and it becomes a wider regional conflict. And of course, we're talking about the involvement of Iran. For now, the Secretary of State says that there is no evidence that Iran has been involved in the attack on Israel. With that being said, we heard news today that the US is sending aircraft and warships closer to the region. For now, it is a wait and see. But folks, let's be honest here. This conflict has been going on. Israel-Palestine has been going on for over 70 years now. It's nothing new. Maybe the scale is a little higher than before, but there is nothing new here to disrupt the stock market or the economy here. But of course, for now, all eyes regarding the conflict comes back to oil. And if you're looking at the futures right now, oil is up about 4% in the pre-market session. And this is a proper reaction for now because we could see a risk of disruption in supplies. Now, when we talk about oil, this week, the WTI or Brent, doesn't matter which one you choose to look at, we're down almost 9% for the week. That is staggering. And if oil crashed like this, then what is the reason? Is it manipulation? I have my theories, of course, but it also happens to be on the same day that we got an ADP report for the private payrolls in this country, and the number was weak. And immediately we started talking about, okay, if the number is weak now, then the next number will be negative, and we will start to see the unemployment rate moving higher. And here we go, the economy is heading into a recession. And then oil prices went down big. And of course, it came along hand in hand with the news about worries about demand, so it seems to me that the effort was manufactured and coordinated. A mission accomplished. Oil went down by about 9% for the week. But I made a video that day and said, really? Now we're talking about a recession all of a sudden? All of you pumpers have been talking about how great the economy is, right? Bull market, the economy is doing fine. But you also want oil prices to be down, and you're manufacturing stories about a recession and fears about the unemployment rate moving higher to drop oil prices down. Well, I say you can't have your cake and eat it too. Either we have a healthy economy, and that will come hand in hand with higher inflation and higher oil prices, or we have an economy that is crumbling. And the warning from oil is just a leading indicator to what's about to happen to the stock market, to consumer spending, and corporate profits. Now, hold that thought. We'll talk about the economy, whether it's closer to a recession, or is it really growing and creating more inflation? But now let's talk about oil for a little bit here. Because last week we talked about the phenomenon that we see crude oil, heating oil, also known as diesel, all moving higher in tandem. And usually we see the gasoline RBOB futures. In this chart, you can see that in gray, also moving in tandem with these two. But recently we have seen somewhat of a divergence, where the gasoline RBOB futures been crashing, yet oil been surging higher. And I said, one of these two is lying. Something is going to happen here. And of course came out the story that refiners are now refusing to buy oil because the prices are too high. So we see demand destruction. In other words, the gasoline RBOB is right, and we saw crude oil and diesel prices getting crushed this week. Here's the problem though. The refiners can say all they want, that they refuse to take the higher prices. It's not up to them at the end of the day. The dynamics for oil prices right now are favorable for higher prices, not lower. And what's going to happen now that we've seen a dip in crude oil prices, the refiners will take that as an opportunity to buy these crude barrels. And we will see crude recovering. We will see the RBOB also recovering. Because when you look at the deficit here in supplies, it is staggering. In the third quarter of the year, which we're in right now, we're short about 2 million barrels per day. We can talk about the reopening of the Keystone pipeline by the Joe Biden administration, ironically. That's not going to cover 2 million barrels per day. The domestic production is actually down all in all, although it's being compensated for by non-OPEC countries increasing supplies. And that is mainly Venezuela and Iran. So now we go back to Israel. If the conflict now widens and all of a sudden involves Iran, then we're going to have a problem here in oil prices shooting significantly higher, because Iranian supplies will be off the market, and that will take us down to a shortage north of 2 million barrels per day. When we look at the global oil inventories in days of demand coverage, we're now hitting new lows. Less than 40 days worth of coverage in inventories. So the refiners can say all they want that they refuse higher oil prices and the demand is low. At the end of the day, they're going to capitulate and realize that they have no other choice but to buy oil right now, because the dynamics will push oil prices higher again. And as investors, it gives us the opportunity, the dip that a lot of you have been waiting for, to buy some of these energy stocks and energy exposure. We'll look at the Money Manager Positioning Index. They have turned positive for the first time this year. In other words, they've been negative in oil throughout the year. Now they've become positive. Now they're pouring money back into oil. And sure, maybe they got some bad timing because of the drop this week, but it means that the sentiment is now changing and they will use the dip as an opportunity to buy. Is it really a surprise that we see crude oil moving higher by about 4% in the pre-market session overnight as you see right now? Of course not. And of course, lucky for us, before the jobs report came out, I gave a few trades here based on the scenarios and how the report would come out. So I said as expected or better, we're buying the XLE, which is also the energy ETF. If the number comes out less than expectations, then we're going to go with buying the QQQ, which is the NASDAQ. We're buying calls on that. If the number is disastrous and matches the ADP, then we're going to go with the SLV, the Silver Fund. Well, guess what? Regardless of the scenario, which was hotter than expectations, all of these trades worked out. So sometimes you have to look up and thank the big guy, because all of them worked out. But of course, why did all of them work out? The reason is, in response to the hotter jobs data, we saw bond yields, the dollar shooting up higher. But then they reversed. And just like when they say, oh, the stock market bottoms on bad news, sometimes charts top on really good news. And Friday was really good news for the dollar and bond yields, but they decided to top. That is a technical top. It lasts for a little while, then the fundamentals come back in and we see bond yields and the dollar moving higher, and whatever rebound the equities market will stage will fade away at that point. But the bottom line is, if the employment data shows that the economy is creating jobs and the ADP was just a throw-off, then energy, in this case the XLE or the commodity, went down with no justification at all. It was an overreaction, and the opportunity was for us to buy the dip in oil. And some of us who did, we got rewarded. So now let's talk about whether the economy is really weak or strong. Which one is it? Because you can't have your cake and eat it too. The headline that we got on Wednesday from the ADP regarding the private payrolls showed an increase of 89,000 jobs in September, which is way below expectations, way below the pattern from previous months, indicating that perhaps the next report will be negative. So all of a sudden we got some recession fears. Folks began talking about, oh, the next step will see the unemployment rate moving higher. We're going to start to lose jobs. And oil went down. But it was the only asset that responded in a recessionary way, which is again, bring out all of these tinfoil hat theories. But then comes Friday and we get the government data from the Kitchen Bureau statistics. And of course, the media now talks about, oh, the economy is way stronger than Wall Street thinks. Okay, if it is way stronger than Wall Street thinks and everybody else thinks, then oil prices should recover because there is no worries about demand when it comes to the domestic consumption of crude oil. You can't have it both ways. On Friday, expectations for jobs were 170,000. What we got instead is 336,000 jobs. That is a stunning number, defying all expectations. A blow-off number, which again revives the worries that good news is bad news, because if the economy is creating jobs at this pace, then it means inflation will be sustained and will require harsher interventions by the Fed in the future. And that's what really scares the stock market. But again, the technicals have a role here, and they decided on Friday to reverse down, defying the good news. The good news for what? The good news for the dollar, the good news for bond yields to go higher. And the equities market took advantage of that and decided to rebound. So again, which one do you believe? Do you believe the data from the ADP that perhaps we're seeing the economy slowing down and we're seeing the pace of job creation dropping down dramatically to the point where in the next report we might see a negative number and the crash in oil was granted? Or do you believe the government data that the economy is still hot, still producing a lot of jobs, still inflationary, and in that case then the drop in oil prices was just a mere overreaction and it's going to recover and move higher again? When we look at the data, we see the beginning signs of an economy that is now buckling and crumbling under the high pressure from higher interest rates. And a reminder, the data is being cooked all over the place. So they give us a piece of data, then they revise it down later on, revise it up later on. And the latest example is household savings. Well, if the economy is healthy, then you better hope that household savings are actually doing pretty good. Well, now we get the headline that U.S. households saved $1.1 trillion less. Keyword less than previously thought over the past 6 years. Oh, wow. according to revised government data. So you see all the previous estimates that they gave us going back all the way to 2017. They were all phony, and the actual reading was a lot lower. So if the consumer has less savings right now than we previously thought, and oh, by the way, because of higher rates and higher inflation, they've been racking credit card debt like crazy. And now we have the resumption of student loan payments. So what do we see? Here it is. The headline reads, U.S. consumer credit posts the biggest drop since the pandemic as student loan payments resume. And the sub-headline says, yet credit card use rises sharply again. You put it all together. If consumer savings are worse than expectations and what we knew before, or thought that we knew before. And oh, by the way, the consumer is using credit cards as a last resort to battle this inflation problem, and their credit is actually dropping like a rock because of higher interest rates, then the inevitable conclusion is the consumer is getting weaker. And at some point, the consumer's knee will buckle to the circumstances. And if the consumer goes kaput, who's going to hold the economy here? If the consumer goes kaput, who's going to hold the stock market? In other words, who's going to hold the so-called Magnificent Seven? We already see the warning signs, folks, that consumers are about to get a lot weaker. The Wall Street Journal says, new this holiday season, discounts on shipping packages. We see UPS and FedEx reducing prices now, which is deflationary. Why? Because they anticipate weaker demand. So again, this supports the evidence of the ADP and the drop in oil. Why are they reducing the prices, UPS and FedEx? Well, because we have a weaker holiday season. The number of parcels are actually going down from previous years. Now, bear in mind that UPS and FedEx are now paying their workers higher wages. So if they're going to reduce prices and the demand for shipping is going down, then the inevitable conclusion is, at some point, sooner than later, UPS and FedEx will have to lay off employees as their margins get squeezed. Also this week, we got the headline that Tesla's cutting prices again. So if the demand is way too high and the consumer is doing fine, then why is Tesla cutting prices over and over and over and over again? Reducing the margins over and over and over and over again. And by the way, this is part of the Magnificent Seven, the stocks that are holding the stock market right now. If a stock like this falls, then we lost one of the seven. And a reminder, in the movie, at least 4 get whacked. In other words, the stock market will face the same ending as the actual Magnificent Seven. And why is Tesla reducing prices to begin with? Well, here's the other headline. Tesla China-made EV sales volume falls 10.9% year-on-year in September. And again, we tie it all up. We go back to the bond market. Why do we see bond yields shooting up significantly higher? The answer is bond issuance is going out of whack. The supply is out of whack. Why? Because the government continues to spend like a drunken sailor, racking in all of this deficit. You can pay for deficit in 2 ways. You can raise taxes. Well, that's a no-go with an election season coming out. The other way is to issue more and more bonds. But the side effect of that is, as you issue more bonds, you increase the supply, you drop the prices, and you increase the yield on those bonds. And then we face a phenomenon like 87. We face a phenomenon like 2008, 2009 if we hit a systemic risk event. But the other important finding is, again, we tie it up all with the economics. When we see the budget deficit rising significantly higher, it usually comes hand in hand with an increase in the unemployment rate. And here's another way we can visualize all of this. You can see in blue the deficit as a percentage of the GDP, and it has a really good correlation with the annual unemployment rate. And as we see the deficit as a percentage of the GDP moving higher, the expectations are that we will see the unemployment rate also moving higher, along with the increase in the deficit. In summary, bond yields, the dollar, and oil prices will continue to surge higher. Sure, they will get pullbacks and scare events, just like we've seen with oil last week, but they're going to continue to go higher and higher and higher until something breaks. And that will be either money flocking into bonds once again because a credit event, or money flocking to bonds because we've seen a 1987-like phenomenon. And then we see what? We see bond yields getting crushed, we see the dollar moving down sharply, and we see oil prices retreating. But that will happen for the wrong reasons. And we will see the unemployment rate moving higher, and that will mark the recession and the end of the quantitative easing experiment, because after that, we have to talk about how do we rescue the economy from here. And if the answer by the Fed and the federal government is to issue more stimulus and to cut rates all the way back to zero, then guess what? The inflationary dynamics in the economy from the shortage of supply side is still here. So all what they're going to do is revive inflation back up. And all what they're going to do is create a transitory rebound in financial asset prices, but it will not do anything to rescue the economy. This time around, we can't just revive the economy by more stimulus and lower interest rates. This time around, we have to eat it, and we have to see an organic recovery of the stock market and the economy. And that's going to take time. And between the collapse and the recovery, it's going to be a difficult time. It could be a lost decade. It could be a period of economic stagnation. But of course, the actions and the decisions by the Federal Reserve and the federal government will decide whether to prolong the period between the collapse and the recovery or to shorten it. And the key to shorten that period is to solve the root problem by being responsible when it comes to the fiscal and the monetary policy. And then we see an organic recovery for the stock market and the economy. But it's going to be a long time between now and then. So in the meantime, the market that we have right now, what are the opportunities? If we're talking about, okay, we might see a transitory pullback in bond yields and the dollar, and we see an oversold technical rebound in equities, what are the opportunities here? Well, you have to go back to what we've been talking about, because in mistakes come opportunity. One of the classic mistakes this year is pumping the stock of Nvidia, for example, because of a transitory period of exploding demand due to the AI mania. And with that also comes the pricing power of Nvidia. But all of this is transitory. The mania will subdue, and as we see economic weakness creeping up, companies will start to cancel orders. They cannot pay for these chips anymore. We will see that all of this bump in revenues and the pricing power in Nvidia was only transitory and did not merit expanding the multiple for the company to this magnitude, and we will see the stock crashing. So in mistakes comes opportunity. But what about the stocks that got crushed right now? I mean, look at oil. The moment it got crushed, then comes the news that, oh, the jobs report is actually a blowout number. And over the weekend, you have what's going on in the Middle East. And in that overreaction, the opportunity was to buy the dip in oil. Do we have any other dips here that are results of mistakes and overjudgment and overreactions that could produce rebounds in the next few days, perhaps the next few weeks? The answer is absolutely. And for that, we have to look at the correlations chart here. We know that the most sensitive assets to the dollar are metals. When the dollar goes higher, as we've seen recently, we saw the value of gold, silver, copper getting absolutely clobbered. If the dollar goes down, metals are going to recover. Likewise, the most sensitive assets to bond yields happen to be home builder stocks, dividend-paying stocks, banks, retail stocks, and any high-debt sectors of the stock market. When bond yields went higher, all of these stocks got crushed. If bond yields cool down for a little bit, we can see a relief rally in these assets. Likewise, the most sensitive assets to oil prices happen to be transportation stocks. And as we saw the big drop in oil prices this week, we saw transportation stocks recovering and moving higher. Whether you look at airline stocks or the ETF jets or the transportation ETF, we saw somewhat of a recovery and a rebound as oil prices went down. And now as oil prices go higher, these sectors will also come back and suffer again. When it comes to the most sensitive assets to the VIX, it's the indices of the stock market. So when you saw the VIX moving down on Friday's session, the indices recovered. So what do we have on Monday? We have the bond market closed for the holiday. So we're not going to have any bad news from the bond market, at least on Monday. And the technical patterns, we'll look at that in the charts analysis in a minute. It looks as bond yields are running out of gas for now. They might pull back before moving higher again. The same can be said with the US dollar, despite the pop that you see overnight because of the Israel conflict. So we have to look at oversold charts that got absolutely clobbered with overreactions. And we can look at that and say, okay, here's an opportunity for a rebound that I can play for a few days, few weeks, either by using options or stocks. You look at consumer staples, the XLP. The ETF got hammered because the majority of stocks in this ETF happen to be dividend-paying stocks. And if bond yields, the risk-free rate is going higher, what would you bother holding any of these stocks and assume the risk too? As bond yields now pay you more. And that is challenge number one. Challenge number two for these names, the staples, specifically food stocks, is the Ozempic mania. And now we have talks about, oh, there's all of this wide usage of Ozempic. And the appetite of many Americans are being suppressed. So they're not spending more on food. And here we go now, they're dumping all of these food stocks. But again, is it really merited here if we look at the results and the earnings of these companies, or is it just a narrative to drop these stocks down? And if that is the case, then we have an opportunity for a rebound here. You look at the chart of the XLP, we see perhaps a bottoming candle in the daily chart. We might see a rebound that could last for a few days. Here's another one, CAG Conagra within the XLP, a packaged food name, and it got dropped big time because it is a dividend-paying name. On top of course, the Ozempic effect here. That all folks is they're going to take Ozempic, they're not going to spend money buying Conagra products. Stock goes down, becomes severely oversold, trades outside of the lower Bollinger Bands, catches a recovery, and this recovery could last for a few days. You look at the daily chart for GIS, General Mills, another food name within the Consumer Staples ETF, XLP, hammered, bruised, brutalized, because of what? Why would you hold it if you have bond yields paying you more? Number one. Number two, the Ozempic mania. Who's going to buy cereal now? That's the assumption, not necessarily the fact. So the stock gets hammered, becomes severely oversold, trades outside of the lower Bollinger Bands, catches a rebound Friday, and this could be an opportunity for the stock to rebound for a few days. You got the ticker KO, Coca-Cola. Massive dump this week. You look at the daily chart here, to the point where the stock became really oversold and traded outside of the Bollinger Bands, which again, it becomes a no-brainer that we're going to see a rebound. And the rebound could last for a few days, maybe a week or so. Again, why did Coca-Cola go down? High dividend-paying stock. And of course, the Ozempic narrative says if folks are taking Ozempic, they're not really drinking soda. Whether that's the fact or not, that's a different story. And the same can be said with PEP, PepsiCo. This is a daily chart. Again, became really oversold, way outside of the Bollinger Bands. Could be an overreaction, aka a mistake, and mistakes, we see opportunities. Another name is MDLZ Mondelez. If you're taking Ozempic, you're not eating Oreos. That is the assumption. Of course, Mondelez also pays a handsome dividend, so they drop it down. But now it became really excessive. And in mistakes comes opportunities and rebound plays. MCD daily chart from McDonald's. Look at this. Massive drop because of the Ozempic mania and the narrative that, oh, if you're taking Ozempic, you're going to stop eating McDonald's. And if you're not taking Ozempic, you're also going to stop eating McDonald's because others are taking Ozempic. Overreaction? Sure. Offers opportunity for a rebound? Yes. High dividend paying name that got crushed with yields going higher and the bond market is closed on Monday? Sure. All cases for a rebound here. Then we got STZ Constellation Brands. You look at this daily chart, way oversold, way outside of the Bollinger Bands, and it goes with the same narrative that if you're taking Ozempic, you're not really drinking beer anymore, and it's a dividend-paying name. It pays about 1.5%. That doesn't compare with the rate and yields from bonds, so you got to sell it. But the facts say that once Bud Light went down, Modelo took over, and the company's actually making more revenue than before, and the report was pretty good. So again, in mistakes, we find opportunities. VLO, Valero, this is a daily chart. Oil prices dropped down because of the demand destruction story, which we know that's going to happen later on, not right now. The dynamics are actually supporting higher oil prices right now, and this will support capitulation from refiners, and the gasoline RBOB will go higher again. And the drop in crude this week was an overreaction. We see a recovery right now, so we should be seeing a recovery in Valero as it became really oversold and outside of its Bollinger Bands. And then we have classic Dow stocks. If you look at BA, Boeing, a classic name, dividend-paying name. A lot of investors buy Boeing because of the dividend and the stability. But then why bother if you have higher yields? Well, if yields are about to stop because the bond market is closed on Monday, and maybe we have a technical top for now, then we should see an oversold recovery here in Boeing. Another name is HD, Home Depot. Once again, bond yields go higher, demand for housing, and all of these dividend-paying names, the classic blue chips, they go down. But if bond yields stop for technical reasons, at least in a transitory way, then we should see a transitory rebound in Home Depot. That is an opportunity, a trading opportunity that we can take. And again, you can look at all of these charts. All you have to do in the morning is look at bond yields. You're not going to see anything. The bond market is closed. All you have to look at is the dollar and the VIX. And if it appears that we have a gap and crap in the dollar and the VIX, and the Israel story is not really sticking, then we're going to go back to the same dynamics. We got oversold technicals in the stock market, and we got overbought technicals in the dollar, bond yields, and the VIX. Those come down, and we see equities recovering in an oversold rebound despite what's going on in the Middle East right now. And then the situation in the Middle East gets worse. The stock market becomes no longer oversold. All of these oversold mistakes are fixed. The dollar, bond yields, the VIX, they become not so overbought. They get a dip. And then we see them moving higher again. And we see the equities market moving down again. That's the outlook for now, folks. And let's expand on the conversation here and cover the stock market activities for you. And we begin with the closing of the indices on Friday. And here we go. The Dow Industrial Average closing positive by 288.01 points, or a gain of 0.87%. The Nasdaq up by 211.51 points, or a gain of 1.60%. Likewise, the S&P in the green by 50.31 points, or a gain of 1.18%. We look at the sectors on Friday, all in the green, all positive, oversold rebound, and a technical rebound because the dollar reversed along with bond yields, yet we see defensives lagging. So I see the opportunity here. If bond yields are closed, if they drop down after the open on Tuesday, I see the defensive sector here offering a lot of rebound opportunities. We contrast this with the weekly performances. What do we see here? It was risk on, believe it or not. The majority of the stock market was down, yet the outperformance came from communication services and technology, aka the AI mania, aka the Magnificent Seven. We look at the breadth on Friday. We got neutral Wednesday, Thursday, and then we got the breakout above the 150 days moving average in the SPY, and we see the breadth now becoming positive. Some would argue a little excessive here. NYSE 71% advancing versus 27% declining. The Nasdaq 60% advancing versus 36% declining. So we can fix this, or the market maker, if we're being honest here, can fix this by dropping equities in the pre-market session, maybe a little bit in the morning. We see the breadth becoming back to neutral, if not a little negative, and then we see a rebound, and the breadth comes back to neutral at around the 50-50 line. When we look at commodities on Friday, what do we see here? Rebound across the board. So we see metals rebounding, and the rebound happened right off the gate. So immediately, something was suspect here. We saw hot employment data. The dollar was up, but so was silver. So was gold. So was copper. And right off the gate, looking at that, something didn't add up here. And the end result is the dollar said, okay, metals, you want to party, go party. I'm going to go to sleep right now. And we saw gold up, silver up by a little over 3.5%, platinum, palladium, copper, all in the green. Likewise, we saw gains across softs led by sugar, cocoa, orange juice continues to go higher. We saw some declines from grains, wheat, oats were down, but then we'll look at energy. We saw a rebound in Brent and WTI, worth about 0.5 percentage point apiece. So this was a leading indicator that maybe we have a bottom here in crude. Whether you knew about the Middle East situation or not, the technicals were saying you got to be long crude here. You got to buy the dip. If you did, you got rewarded. Oh, we got rebounds in heating oil, not so much in the RBOB, but the party boy, natural gas, adding to the gains with about 5% on Friday. Why is natural gas gaining? The reason is you have a lot of technicals playing out here. We talked about the chart and how once we have a breakout above 3, you're going to start to see short covering, and this is propping up natural gas prices for now. And of course, the trade was buying the ticker BOIL. And if you did, that ticker exploded higher this week. We'll look at that in the heat map analysis, but we're about to face resistance here at around $3 and 395 basis points. So maybe we see natural gas pulling back a little bit and then allowing money to flow back into crude, taking profits in natural gas, rotating back into crude. That could be the trade of the week. And if we look at it all in all, for the week, the winner, natural gas on top, off the charts, gains north of 13.5% for the week. OJ continues to gain with about 8% worth of gains this week, and wheat, of course, gaining about 5% this week. The losers, led by diesel, down about 12%, along with, of course, crude, the WTI, RBOB, Brent, all down almost 9% apiece. Moving on to the big casino, the options market, what do we see here? We see that the volume moved higher on Friday, but not only that, we saw call options demand moving higher. So the ratio of puts versus call improved toward calls. Again, this solidifies that the rebound that we got on Friday will last for a little while, despite the Israel-Palestine news. If we look at the 5 days average put to call ratio, what do we see here? We're now above the 1 line, which means we're buying more puts versus calls. But I believe that we'll see a dip here in this reading, meaning we're going to see folks buying calls throughout this week. And then we have a catalyst. It could be the PPI, could be the CPI, could be another catalyst. Could be a flare up in the Middle East where Iran is involved now. And then we see the resumption of buying puts until we get the extremes. We see the crash, the big pullback, and the rotation from stocks to bonds. And then we'll talk about stability in the stock market. But at that time, would anybody be brave enough to buy? Well, that's a conversation for another time. For now, we take it one step at a time here. We look at the unusual activities that took place in the options market on Friday. We see that we have trades for the IWM, somebody buying calls, somebody buying puts. I believe that this could be the same trader here. But in any case, they see volatility coming in the IWM small caps. If we look at the daily chart, we see oversold conditions and perhaps a potential for a rebound rally. If we look at the long-term charts, we'll do that in the charts analysis, we see that the IWM is destined to go down. So this could be a trade where somebody's selling the 163 puts with the expiration date of October 27 to raise some capital and buy the 190 calls with the expiration date of December 29. And the way they see things here is the IWM rebounds not necessarily all the way back to 190, but 180 will be good enough here for the trade to be profitable. And then they book the calls, and what happens? The puts that they sold, the 163, are now way out of the money. And once we get closer or beyond October 27, they see the IWM going down again. So again, I look at this trade as somebody sold some puts, short-term puts, to finance a longer-term call, bidding on a rebound here for the IWM. Then we'll look at the ticker SMH. This is the CHIPS index, and again, somebody's buying calls, bidding for a rebound here, worth about 9.5% or more by the expiration date of November 17th, and they paid about $1 million for those. So again, it solidifies that we could see a rebound here, that a lot of traders see an oversold rebound. But then we'll look at the trade for ALK, Alaska Airlines, or at the bottom of the table, you have DAL, Delta Airlines. We have traders now buying puts in both. We know that oil prices are rebounding higher. We know that jet fuel prices are going higher. We know that wages are going higher for these companies. But demand for travel, now that we have the resumption of student loan payments, demand for travel is going down. I've been bearish on transportation. I've been bearish on these airline stocks and cruises. And I'm going to stick with the bearish take here as I see traders also pointing out more declines to come in these airliners. We move on to the heat map. What do we see here on Friday? Mostly in the green. It was rebound day. Few exceptions, of course. We talk about healthcare. We see Pfizer. Pfizer was the winner for the week. We saw some profit taken on Friday. When we talk about real estate, this is really important. You see that we have rebounds across the board. But when it comes to offices and the REITs at risk from higher rates, they're not rebounding. And that could be a leading indicator that whatever rebound we have right now, it's not going to last for too long. Then you look at metals. We got a nice rebound here because of the dollar going down. And of course, that comes with energy, mostly in the green. But the exception is the big guys, Exxon and Chevron. We got the news that Exxon is buying Pioneer, and now we have speculations that maybe we'll see more M&A from Exxon and Chevron. They'll buy smaller companies and consolidate more. That means they're going to spend a lot of their cash, and they're going to dilute the equity value. So for now, if you're going to play the energy sector and buy dips, maybe you want to avoid buying the ETFs because the big guys will be a little slow due to the M&A speculation. But you want to focus on the high beta names such as the oil and gas names, HES, Oxy, Occidental, or even PXD, Pioneer, if you see more gains to come, LNG, SLB, even the refiners, Valero and MPC, Marathon, those are better plays than the ETF for now. We saw some pain on Friday for the packaging names, consumer defensives, the food names, and this is due to the Ozempic impact. I believe it's overdone right now. I mean, they're selling Walmart, they're selling Costco, they're dumping Kroger. I'm sorry, but Ozempic or no Ozempic, folks have to eat. And I think the impact of Ozempic is being overhyped here. So you look at cyclicals, for example, mostly positive, but then you look at McDonald's and the restaurant names, and they're all down, also because of Ozempic. You look at communication services, we see Verizon and AT&T down because while we saw the dollar reversing, we did not see bond yields really reversing. They dipped from the highs, but didn't show any pattern of a reversal yet. So we see the high dividend paying names, Verizon and AT&T down for the session. However, on Monday, we'll see the bond market closed. So we could see rebounds here on Verizon and AT&T. The rest of the market on Friday was green, led by technology, the big caps, chips, and software. And of course, the Ozempic mania in healthcare, led by Eli Lilly, Mounjaro, and NVO, Wegovy, and Ozempic. We contrast this with the weekly heat map. What do we see here? We see pain across the board. Few exceptions. The Magnificent Seven, Microsoft, Apple, Nvidia, Google, Meta, Tesla, along with some of the AI mania names, such as CRM, Oracle, Adobe, AMD, all managed to perform this week. Then we see the insurance names, such as the healthcare insurance names, be it UNH, United, or HUM, Humana. And then if we look at the insurance policies, PGR, Progressive, was positive for the week. Likewise, Visa, be swapping those cards. They continue to charge. Visa was up. But besides that, the market was weak all in all. If you look at banks, Bank of America was down almost 5% for the week. That is worthy of paying attention to when we talk about the systemic risk. You got Charles Schwab, HCHW, down about 6% for the week. And then, of course, you got the massacre in energy. And then you got the dividend-paying sectors, be it defensives, be it cyclicals, be it utilities, real estate, all getting massacred. And of course, the massacre is led by the ticker NEE in utilities NextEra Energy, down about a little over 12% for the week. So we have a lot of sources for concern here. And the fact that the market did okay on a weekly basis on the backs of the Magnificent Seven, the AI mania, and a handful of names doesn't really give us any source of comfort here. We contrast this with the heat map for the ETFs, the weekly heat map. We see that we got a massacre in bonds, the TLT down about 4.5%, the TMF, which tracks the 20-year, down by more than double digits for the week. So the bottom line here is bond yields went higher. So right away, any bond-sensitive sectors and ETFs, they also got crushed. You look at the XLP, staples down, XLU utilities down, IYR, real estate down, home builders, XHB, construction, ITB, all down. Regional banks, KRE down. But the dollar maybe showed a little sign here of topping and moving down. So right off the gate, we see that the GDX gold miners, be it negative, did a little better. But we see some of the dollar-sensitive names in multinationals in the technology sector doing a little better, and of course that comes hand in hand with the AI mania. So we see the SMH, the chip index, leading the gains, and of course the contrast couldn't be any clearer here when you look at large cap growth, the IWF, the VUG, all positive for the week, value, VTV, IWD negative for the week, mid caps, small caps, all negative for the week. The winner, though, was natural gas, UNG, and the ticker BOIL, up a little over 26.5% for the week. Let's do some charts here and wrap it up. We begin with the SPY, the S&P 500, an hourly chart. What do we see here? Nice rebound on Friday. Barely any red candle except at the end there, but it's really critical. The close was critical. A closing above 430 would have solidified the rebound and the bullish reversal here. The fact that we closed below 430 is a source of concern, but it's not really a stamp that this is a dead cat bounce. Matter of fact, I believe, with the bond market being closed, with the dollar perhaps not holding the rebound from overnight, we could see the SPY maybe opening negative, revisiting 426, for example, then forming an A, B, C pattern before recovering and moving higher again. And the reason is, if we look at the E-mini index, the daily chart for the S&P futures, we have a decisive closing above 4,300. We can go down and pull back because of Israel-Palestine, but then you look at the RSI, we have positive divergence now. You look at the MACD indicator, we're about to have a crossing here, producing green impressions in histogram indicating that the momentum is now turning positive. So for now, I would say that absent of a massive surprise in the Middle East, if the situation stays the same for now, I believe that whatever dip we're getting overnight will be bought and equities will manage to close in the green. When do we start to become concerned here? You look at the SPX, the cash index with S&P 500. What do we have right now? As of the close on Friday, closing above 4,300, check mark. Closing above the 150 days moving average in blue, check mark. An improvement in the momentum indicators, the RSI, the MACD, check mark. All leading. The SPX, the cash index, will move higher to at least retest the 20 days moving average. And that stands in or around 43.60 on the SPX. Now, when do we become concerned that the oversold rebound is not going to happen? What's going on in the Middle East will have a greater impact. If the SPX loses the support of the 150 days moving average, most importantly, closes below the 150 days moving average. We look at the weekly chart for the SPX. What do we see here? We talked for weeks now about an inverse ABC. We got the inverse ABC. We lost the 20 weeks moving average, which is, by the way, bearish, not bullish, but we see that we went all the way to the lower Bollinger Bands. We caught a rebound. Is it out of the ordinary that the SPX moves higher in a retest of the 20 weeks moving average and then fail and move down again? Absolutely not. That is actually expected from a chart looking like this, but it doesn't really erase the negative momentum. You look at the MACD, we have negative momentum. If you look below, we have the vortex indicator, and the red line has crossed the blue line, indicating the bearish momentum has taken over. And this is a weekly chart. Takes a long time to be worked out. So absent for weekly closing above the 20 weeks moving average, the SPX, the S&P 500 is inevitably going down. But on the daily chart, we see oversold conditions. We see the potential for more gains in this rebound. You gotta look at the time frames and play them the right way. In the short run, we're positive. In the long run, we're negative. If we look at the Qs and hourly chart for the NASDAQ, what do we see here? Massive rebound off a topping head and shoulder pattern, by the way, that played out in the morning. We got a gap down, but the gap was bought right away as we saw the dollar reversing, as we saw the VIX reversing, as we saw bond yields cooling off. but not reversing yet. The closing came above 361.40, my threshold, so the Qs is bullish, regardless of the pullback overnight, regardless of the drops in the morning. What we could be seeing here, if you look at the RSI, it is overbought a little bit in the hourly, so it is not out of the ordinary that we see a pullback in the Qs, but the pullback could be bought right away, forming an ABC pattern. Why do we say that? You look at the daily chart for the Qs. On Friday, it managed to close above the 20 and the 100 days moving average, as you can see in white, the 20, the 100 in blue. The chart managed to close above both, and we see the momentum now turning positive, and the rebound came at a higher volume. All indicators that we have at least a rebound attempt going on here that could be lasting for a few days, if not a few weeks. And I'm not going to underestimate any of that. If we look at the weekly chart for the Qs, what do we see here? We got the inverse ABC. Now we see the chart retesting the 20 weeks moving average. So long as it stays and closes below the 20 weeks moving average, then the bearish momentum is granted. And in the long run, the chart is going down. But if we have a weekly closing above the 20 weeks moving average, then the chart turns bullish. And then we have a different conversation. We look at the daily chart for the NASDAQ futures. What do we see here? Number one, we got a double bottom pattern. It played out. Number two, closed above 15,000 and closed above the 100 days moving average on the futures. Number three, we see that the RSI or the MACD all turning positive again. You put it all together, we cannot say from a technical standpoint that the chart is going down or that the rebound that we got on Friday is a dead cat bounce. Israel or no Israel. And this is why I say that whatever dip we're getting right now, I believe that the algos will buy them and push us higher again, absent of a massive escalation here. What about the IWM, the small caps index, daily chart? What do we see here? Caught a nice rebound, bullish engulfing candle and higher volume on Friday. It was really oversold in the RSI, really oversold in the MACD, but we see signs of life here. It is lagging the S&P and the Qs. Now we can interpret this in two ways. We could say that the IWM will play catch up and will lead the gains this week versus the Qs, but then we have to look at the weekly chart, and what do we see here? Regardless of the rebounds in the Russell, what we see is negative momentum in the RSI, negative momentum in the MACD indicator, a confirmation from the vortex indicator. You see the red line crossing the blue line, confirming that we have bearish momentum. So the rebounds can take us all the way to 180. They can even take us all the way to the 20 weeks moving average. And even with that, it doesn't change the fact that in the weekly chart, the momentum is bearish. If we have a closing above the 20 weeks moving average, then we're talking. But absent of that, longer term charts, bearish, shorter term charts could be bullish. And it all revolves around the indicators. And one of the most important indicators is the dollar index, the Dixie. When we look at the daily chart, we traded a little above the upper Bollinger Bands. And since then, we got a drop, 3 red candles in a row, closing below the bottom of the breakout candle and forming negative divergence in the RSI, negative momentum in the MACD. No solid confirmation yet, but we know that we have the 20 days moving average as support. And so long as the dollar is cooling off and not under impulsive rally and a breakout, the equities market and metals love that fact. So we look at the weekly chart for the Dixie. What do we see here? A bearish closing candle. Morning star, shooting star, doesn't matter what you call it. The terminologies don't matter to me. What matters is it's a topping candle. It went outside of the Bollinger Bands and then closed at the lows of the week. So for now, regardless of what's going on in the Middle East and maybe the rush to the dollar, the safety of the dollar overnight, the technicals say that the dollar is weakening and running out of gas. And as it cools off, it will be good for the old man gold. Here it is, daily chart. What do we see here? It held on to 18.19 day after day after day. It became really oversold and it managed to pop on Friday. I think gold has plenty of ground to make here. It could rebound all the way to 1859. It could go all the way theoretically in a retest of the 20 days moving average. I'm not going to underestimate that. If you look at the weekly chart for gold, the weekly chart is outside of the lower Bollinger Bands right now, which is quite unusual. It merits a rebound rally, a recovery, but it doesn't change that on a weekly standpoint, the chart of gold is actually bearish and point out to more declines to come. Absent of what? Closing above the 20 weeks moving average in white. We look at the SLV silver weekly chart. We traded outside of the Bollinger Bands. Now we have the cross. Rest in peace to the bearish momentum. Here comes the bullish momentum. Higher volume. We could see an oversold rebound. We've seen the inverse cross on tops before. Now we see a bottoming sign here for silver. But does it change the outlook from the weekly standpoint? The answer is absolutely not. It remains bearish, absent of a closing from weekly standpoint above the 20 weeks weeks moving average in white. And here it is, daily chart for UK oil. Brent, what do we see here? You got really oversold. Look at the RSI. Look at the trading outside of the lower Bollinger Bands. Even without the news from the Middle East, you should have known on Friday. You gotta buy the dip in oil here. We should see a rebound, at least to 87.28, if not all the way back to 90. But oil doesn't become bullish again, absent of a closing above the 20 days moving average. Now, to be more generous, absent of a closing above the top of the breakdown candle, which is in or around 91. If we look at the daily chart for the XLE, the energy ETF, we know that the weighting of Exxon and Chevron will be negative or drag it down for a little bit. Even with that, it was so oversold, it was way outside of the lower Bollinger Bands, it merited a technical correction here that could last for a few days, bring it back up within the Bollinger Bands, and then drop it down again. And maybe you're better off buying the XOP. The XOP has more of the high beta names and more exposure to natural gas. So we see that it did a little better than the XLE. But again, once we saw the trading outside of the lower Bollinger Bands, that became a clear signal. We have an overreaction here. We're going to see somewhat of a correction. Whether it lasts for a long time or not, that's a different conversation. We'll look at the daily chart for the 2-year yield. What do we see here? Little pop on Friday, but given the blowout number by the Kitchen Bureau statistics, we should have seen a massive pop here. Instead, the chart pretty much closed exactly at 5.085 and closed below the 20 days moving average. A little sign of weakness here. It's not a topping sign. It's not a reversal sign. It is just a sign of weakness. If it sticks for now, it's going to provide a relief rally in yield-sensitive names, aka high dividend-paying names. We'll look at the 10-year yield daily chart. What do we see here? Do we have a double top pattern? We know the 10-year is overbought. We know it's technically overstretched here. We know all of that. But the confirmation would have been closing below 4.688 basis points. That did not happen. So we have signs of a pullback here, but we don't have a confirmation. Yet you put it all together, the dollar and bond yields, the risk says that the upside is now limited, looking at the RSIs, and the downside is plentiful for now. What does that mean? We'll look at yield-sensitive names, the XHB, for example, home builders, daily chart. What do we see here? The RSI, the momentum is improving. The MACD is about to cross, producing green impressions in Instagram. If yields cool off, we could see the XHB home builders staging some sort of a recovery here, maybe all the way to 76.86 or the 20 days moving average. Yet when we look at the weekly chart, and this is really important for you to keep in mind, the shorter-term charts indicate we have a relief rally. The weekly chart says we're still bearish here. Look at the negative divergence in the RSI. Look at the negative momentum in the MACD indicator. Look at the vortex indicator showing us the beginning of bearish momentum. Look at the fact that we're trading below the 20 weeks moving average. All of these say that whatever rebounds again on the daily chart, absent of a closing above the 20 weeks moving average in the weekly chart, is still bearish, and the rebounds will be short-lived. And of course, the same can be said with the IYR, the real estate index, the daily chart here. What do we see? Oversold. If bond yields go down, specifically the 30-year, we will see a recovery here in the IYR, and it could outperform the XHB home builders. Another yield-sensitive sector is XLU utilities. It's been hammered as bond yields exploded higher. If on Monday the bond market is closed and bond yields may be showing signs of running out of gas and pulling back, can we see the XLU recovering and at least retesting the top of the breakdown candle at around 85.59? It would not be out of the ordinary. It would actually be expected, but a lot of you look at the weakest name here, the ticker NEE, Next Era Energy. You want to be cute and buy this one because you believe that we're going to have the biggest rebound, and I'd say sure, it could rebound all the way to 54, but you're better off riding the momentum in names that show better signs of life. And my pick, for example, was the ticker NI, utility name, dropped along with NextEra, along with the XLU, but shows better signs of a recovery here. It's already at the top of the breakdown candle at around 24.60. I'd rather be here than being cute and picking up on NEE and hoping that it's going to replicate the performance that you see here. And then we'll look at the VIX, another important indicator that we have, daily chart. What do we see here? No confirmation of weakness yet because it did not lose 17 as support. We see somewhat of negative divergence in the RSI. And of course, the momentum in the MACD indicator is about to turn bearish, which will allow equities to recover here. and stage a relief rally. Of course, overnight, because of the Middle East event, we could see the VIX popping higher. But absent of trading above 20, I think the VIX will flush down again. It will be a gap and crap. And without the bond market, I don't think the VIX can really make it above 20. So keep that in mind. With that being said, again, we talk about the time frames. The daily might be bearish in the VIX, but the weekly, what about the weekly chart here? We see perhaps a topping candle here, but it doesn't change the outlook for a bullish momentum going on in the weekly chart of the VIX. What we could be seeing here is a pullback this week in the VIX, forming a B leg in an ABC breakout pattern. So keep an eye on that. How about Apple, the big kahuna, hourly chart? What do we see here? Positive day on Friday, big breakout here, closing above 177.35, but it's getting a little exhausted here. The hour size is becoming overbought, so it would not be out of the ordinary to see Apple gapping down in the morning, but then recovering in an ABC pattern. And how high can the ABC pattern go? When we look at the daily chart for Apple here, we see number one, that it did not break below the 200 days moving average. It broke above the 20 days instead in white, and that is bullish, now bearish. We see the RSI improving. We see the MACD indicator showing green impressions and histogram. All of these are bullish signs, not bearish ones. But of course, we have the support of the gap at around 181.47. That could be a point of strong resistance, and it could shut the door on any rebound attempt here. We look at the weekly chart for Apple. What do we see here? We got the inverse ABC pattern all the way to the lower Bollinger Bands. Now it becomes up to the chart. Maybe it can rebound higher, all the way to 181.47, or better yet, the 20 weeks moving average in or around that number. Then face resistance and flush down again, because the momentum in the weekly chart remains bearish, whether you look at the RSI or the MACD indicators. How about Tesla, the souffle, daily chart? What do we see here? It managed to close above the 50 days moving average in blue and closed a little bit above the 20 days moving average in white. So technically, this is bullish, not bearish, but it is a battlefield. It is not a decisive closing above the 20 days moving average. I don't have to point it out for you. You can see the potential for a topping head and shoulder on the daily chart. If we zoom into the hourly chart, what do we see here? Despite the gap down and buying the dip and the recovery on Friday in Tesla, it stopped exactly at the same point from which we got the inverse ABC pattern on Thursday, which is the gap-filled resistance, and it couldn't make it. We have negative divergence now in the RSI, negative momentum on the MACD on the hourly chart. I would not be surprised to see Tesla pulling back, but so long as it keeps 257.53 as support, there is the potential of an ABC pattern breakout. Then we'll look at NVIDIA daily chart, and we see that there is potential here for a topping head and shoulder pattern, so long as NVIDIA is trading below 480.88, which is the shoulder line. If we clean up the chart though, we use the moving averages and the Bollinger Bands, what do we see here? The chart is trading above the 20 moving average in white and the 50 in blue. On top of that, we have positive momentum in the RSI and positive momentum in the MACD indicator. So all of these signs say that maybe NVIDIA will make it all the way to the shoulder line, be it at 480.88 or the resistance of the gap, which is around 466. And then it might face resistance and go down again. You're not going to short NVIDIA until it loses the moving averages on the daily chart. And better yet, if you look at the weekly chart, we get a tiny closing below the 20 weeks moving average a couple of weeks ago, but then we got a rebound. And this could be frustrating for the bears who shorted back then, but it could also be a trap for the bulls who bought it at that point, because the rebound could take us all the way back to 466, but we're still going to have a topping head and shoulder pattern. The bears right now, you don't want to short until you see NVIDIA closing below the 20 weeks moving average yet again, and that will be the confirmation that the top is already in NVIDIA, and from this point on, down we go. Last but not least, tulips, Bitcoin. What do we see here in the daily chart? Consolidating in what it appears to be a sloping line of resistance, which is bullish, not bearish. But again, if it wants to go down a little more, it has a rising support line. It could consolidate within these patterns right here, but we need a breakout one way or the other. Breakout above, that leads us above 29,200, that would be bullish. Breakout below, that would lead the chart all the way back to 26,555, and trade below, that would be bearish, and open the door for more losses to come here. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, October 9th, a reminder, the bond market will be closed, but we have a bunch of Fed zombies here from the Dallas Fed, Logan, and Fed Governor Jefferson speaking. Tuesday, October 10, we have the NFIB Small Business Optimism Index and whole sales inventories. No major events on Monday and Tuesday, so it could be a nice rebound day for the markets, but all eyes will be in the Middle East. If the situation flares up, then we're going to have a problem. Otherwise, I think the oversold rebound is on track to continue Monday, Tuesday. Then we see things turning around. Because Wednesday, the 11th, we have the PPI, the Producer Price Index, and we have the minutes from the Fed from the last September FOMC meeting. Now, Thursday, the 12th, will be the most important day because we have the CPI, aka the CPLI. And then on Friday the 13th, we have the import price index along with the preliminary reading of the consumer sentiment from the University of Michigan. With that, folks, this is all I got for you for now. Hope you enjoyed the show. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
You had what it took to get in my office. The real question is whether you got what it takes to stay.